So I think the words perfect storm has been used a lot. We have a global pandemic. It's not just about a location. And therefore, what we have seen so far is that all the governments are put into actions to have a number of measures. One of them is actually to put down a measure or guideline for the financial institutions to have the loan moratorium, which basically a forced payment holidays for all the borrowers of the financial institutions. So that put a lot of pressures onto the finance and the health of the financial institutions. Now, with these situations, the questions to you is, are you ready? The business is not usual anymore, and therefore we need a new approach. So let's look at what typical financial institutions that we have worked with, their typical process or their current process. So when someone tries to apply a loans to the lender, no matter you are offering vehicle loans, personal loans, whether you have collateral or you're without collateral, which is like credit cards or personal loans, they will input your data as a client, and then they will do a manual checking for a risk scorecard for approval. They may refer to third-party or external credit scoring. For example, Indonesia is Apindo, Malaysia is Securitas, and so forth, and will come up with a accept and reject score, right? Is this sufficient to deal with the current situations? The answer is, I think obviously no, unfortunately. So an enhanced approach will be needed. So what do we mean by enhanced approach? We need two things. We need the speed and the accuracy, both able to help with the emergence of artificial AI and big data analytics. How can we get more accurate and faster scoring? Basically, that you need more and accurate, relevant data. That's number one. Number two is that you need a better scoring models, right? So therefore, you may need to think of how you need to structure your operations to have more machine learning driven, to have what I call as dynamic models. And we may also introduce the concept of alternative data so that you offer something beyond what you're already having. Therefore, you can achieve faster and more accurate credit risk scoring to address the objectives, which is basically you are walking in a fine line. Right? You need to minimize the non-performing loan, but at the same time, it is a good time for you to capture new business. The situations are very dynamic. I think every single countries are different. Every single industry is different. The countries will talk about partial openings for certain sectors, opening for certain geographical areas and so forth. And then we are dealing with different numbers, the numbers about jobless, the numbers about GDP, the numbers of COVID-19 patients and so forth. So that's actually the kind of dynamic situations that we are facing. And I see different approach that people try to do. Now we can refer to something that happened in China. They have Alipay, created by Alibaba with Ant Financials. They have this super duper credit score called Sesame Score, and it's supposed to be a very accurate credit risk scoring model. It's no longer work. It's actually confirmed by that because of this situation. There's two dynamic of the situations that even one of the best model in the world is no longer working, no longer reflecting the real situations because of the dynamic changes of the situation. So what can we do? I have learned from a lot of experts. There are economic experts that suggest this. Well, let's define the rules. We have 50 rules, 100 rules. We need to consider the GDP. We need to consider the impact to the industries. For example, I work in travel industries. In this case, there's potentially hit to me that I may have reduced income and therefore I may not be able to repay the loan in the coming payment, and therefore it should impact my credit risk scoring. Do we need to consider sectoral information about stocks or jobless data, and down to the extent that we need to consider potential of second wave coming and so forth, right? So there's too many things that we need to consider, and I think we need to have a lot of experts fresh all this data in. However, this approach to us that's not optimum. Why? Will this even impact you, right? Consider if you are financial institutions and you do all this, and you actually put a lot of weight into, oh, let's give some negative score or weightage to the travel guys, the oil and gas guys, and so forth. But then afterwards, you take a look into your own loan portfolio. You may actually realize that, hey, I don't even have a travel customers, and that's not even the segments that I am tackling, or there's very minimum loans that you're extending to these sectors, right? So by putting so much effort, you may not gain a lot, right? Or you may not even gain something. So what's the better approach then that we should use? If data is hard, we look at the model. What if there's a robust and dynamic models that are built based on your own loan portfolio? Your own loan portfolio won't change significantly, right? And then we use that to predict the loan approval decision. So in this way, we are able to capture your own data points, right? Your own characteristics of your loan portfolio, and do that with confidence. So that, to us, is a better approach. Number one, we would like to monitor your current portfolio, your borrower's behavior. The customer will be updating the data over time, and also I'll introduce the concept in a short while. And we'll look at how they behave over time. As mentioned, this is an adaptive scoring model. It shouldn't be, oh, there's a shock, and then my model no longer works. The score will adapt to the data change based on your own portfolio. So that's actually important. Of course, it doesn't stop there. We need to also improve the scoring, so to enhance the entire lending process. And therefore, spend less time to assess the customers. And in these situations, I think it's particularly useful. A friend of me working for the largest bank in the Southeast Asia have told me that they try to stop to get any more new loans because the system has been overwhelmed, right? So imagine the largest bank in Southeast Asia has to do that. So many people go to the banks and try to get loans. So if you say, for every loans, I need to spend 5 days to process, that's a waste of time. People want to get a yes or no answer fast. That's good for you as a lender, and that's good for the customers as well. So we need less time spent, ideally near real time, right? So we want to assess the customer's creditworthiness to show that they really have the capacity to pay, number one, and they are willing to pay you first versus the rest. The applicant's data is important, but we need to also find ways to get alternative data. So data that you have not really looked at that may offer value. If you have multiple portfolio, it's not just looking at your loans. If you have savings and cards and so forth as a bank, then those are data that we also need to assess altogether. And we also need to consider other data sets, especially from the external, to identify the trends, gaps, and the risks. Then we move on to the touch points. So if you have more and more channels, and which means you have more and more data points for us to assess, and that's important. I'll just give you one example. This data points doesn't sound like very important. We do find evidence that if people are applying loans at night, they are desperate, and therefore there's a higher chance that they are going to default. So this is just a minor point, but you aggregate all these points up, that give you a stronger indications who should you give loan to. So in this case, to achieve the aims. The aim is basically to reduce your risk, and at the same time, optimize your revenue and get new customers as well. So now we have all the data sets, internal, external, structure, and unstructures. We can determine a much accurate credit score. And this is not stopped there. Basically, we need to implement a feedback loop to continuously refine the predictive models, right? So there are different considerations that you may have to input. Let's say you may want to change your business to attract different segments and so forth. So those are new considerations that we have to take in, so that then the models can be tuned accordingly, and so that actionable insights can be now reflected in the credit risk model, right? And then of course, operationally, when you run campaigns, that will help to reduce the cost and grow your profits, and eliminate to target the wrong or bad payers. So I think that's important to strike a balance of getting new customers, but also minimize your NPL. A lot of times, I think you believe you may have already something in existing that you can now extend loans to your customers. That's simply as, if it's very risky, of course, we need to consider reject, right? If it's very good, of course, accept. But the problematic one to you likely to be what will be your actions dealing with the ones that medium risk. So you can't just simply take that, it's very risky. So therefore, the concept of discriminated pricing will be very important. So recommendations can be done based on 3 different factors. Different interest rate to offer, or higher risk but potentially able to pay customers, different tenor, or different loan amount. The first point is that it is enterprise ready. From here, we have a number of advantages to existing solutions. One is that we don't restrict your data model, so you can take in as many as few or as less as few. Of course, that may have an impact on the how accurate it can be if you have less data for us to crunch. Number 2 is that we also enable the APIs, right, to and from your core systems or the loan origin system, so that you can get a near real-time feedback of the score, and of course you can then continue. So imagine that I want to submit this loan, and in, let's say, minutes, it's not days, it's not weeks, but minutes. If your system allows, you get approval, you get a reject, or you get more information to be provided and so forth. That's, I think, is a very good customer experience of you, right? We also talk about using alternative data, right? So the public open data, like the Department of Statistics in different countries, as well as the digital footprint that I talked about. So that's the alternative data that we can provide. The third is flexible. We all know that if you deploy in the cloud, that's actually very fast and potentially cheaper. But a lot of you are actually bound by the regulation, so we can do on-premise as well. And it's very configurable, right? You can, depending on your process or system to be integrated, we have connectors to the different sources. So what we want to help financial institutions is to achieve these results. Number 1, we want to help you to minimize the NPL, but at the same time, optimize the new loans capture or capture the new customers. I think that's important. We help you to walk the fine line and the balance of the best of both worlds.